All right, the holiday season is officially upon us, and you know what that means? Parties, gifts, and hopefully some nice bonuses. But for employers, all that generosity can sometimes come with a surprise tax bill. So today, we're going to run through a quick, super actionable playbook to make sure your holiday spirit is as tax smart as it is festive.
So, let's just start with the big question, right? You want to reward your team, you want to be generous, but are your holiday plans accidentally a gift to the taxman? The hidden costs can really catch you off guard, but the good news is, with a few key strategies, you can avoid them completely.
Okay, let's get right into it. Play number 1 is all about the classic company holiday party, and more importantly, how to make it 100% deductible.
Now, this is where it gets really interesting. The IRS actually has this massive exception for holiday parties that you absolutely need to know about. See, a normal business meal, taking a client out, for example, is only 50% deductible. But a qualifying holiday party, that jumps all the way to a full 100% deduction. That is a huge financial win you do not want to leave on the table.
So how do you unlock that full 100%? Well, the rule is surprisingly simple. The IRS just says the party has to be a recreational social activity. And here's the kicker. It has to be open to all of your employees. Not just the execs, not just the sales team, everybody.
Let me show you how this plays out in the real world. Say you take just your managers out for a fancy steak dinner. Great gesture, but because it's exclusive, you're stuck with that standard 50% deduction. But if you cater a party for the entire office, now you've got an inclusive social event, and just like that, the whole thing becomes a 100% deductible expense.
Okay, that's the party sorted. Now for play number 2, employee gifts. This is an area where your good intentions can really lead to some tax headaches, and it all comes down to a little something called the de minimis rule.
De minimis. Sounds fancy, right? But what does it actually mean? Well, the IRS basically defines it as a gift, where the value is so small that it would be unreasonable or just a huge pain to track and account for it. You can think of it as the too small to even worry about rule.
And this is where the difference becomes absolutely critical. Tangible, non-cash gifts that don't cost a ton, like a holiday turkey, a nice fruit basket, a bottle of wine, those are tax-free for your employee. But cash, and this is the important one, gift cards are considered cash equivalents, and that means they are taxable. It doesn't matter what the amount is.
I really want to hammer this point home because this is the trap so many employers fall into. To the IRS, a gift card is exactly the same as handing someone cash. That means even a tiny $20 coffee card is technically taxable income. It has to be reported on their W-2. It's a super strict rule, and it's so important to get it right.
Okay, and that brings us to our final and I think most impactful play, solving the bonus problem. This is all about how you deliver that awesome holiday bonus without it falling flat and actually causing some disappointment.
We've all seen this happen, right? You get super excited, you promise an employee a $500 bonus. You do everything by the book and run it through payroll so taxes are withheld. But then, the employee gets their check and it's only for, say, $340. And suddenly your big, generous gesture feels, well, a lot smaller.
So how do you fix this? The strategy is called grossing up, and it's brilliant. It means you work backward. Instead of the bonus amount being your starting point, you make the promised amount the end point, the actual cash in hand that your employee gets to take home. Just look at how the numbers stack up. With a standard bonus, your $500 cost only gets about $340 into your employee's pocket. But when you gross up, you basically calculate what the taxes would be and pay them on top of the bonus. So yeah, your total cost might be closer to $700, but the employee receives the full $500 you promised. It is such a powerful way to protect morale and make sure your generosity really lands the way you intended it to.
So let's do a lightning-fast recap of your new holiday tax playbook. 1. For the party, invite everyone, all staff, to get that sweet 100% deduction. 2. For gifts, stick to actual tangible items and stay away from cash or gift cards. And 3. For the bonus, use the gross-up method so your employees take home the full amount you promised.
Which really just leaves us with one final thought. As you're planning your company's celebrations this year, ask yourself this. Is your goal just to be generous, or is it to be smart with that generosity? Because with these simple plays, you can absolutely be both.